When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thanks so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about today's economic market and geopolitical news, what retirees should be watching for right now. We'll also answer listener questions, and later on in the program, should gold be part of your retirement plan? My name's Jeff Shea. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. It is Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
I'm doing great. How are you doing?
I am doing fantastic. We certainly appreciate everybody joining us here for another edition of Premier Retirement. We've got a lot to talk about on today's show, Jeff, so let us dive right in here. Every day we're bombarded, Jeff, with economic headlines. I mean, I'm talking about market news, geopolitical developments, inflation reports, interest rate speculation, you name it. But the question that a lot of retirees are asking, I think, is pretty simple. What does all of this mean to me? So let's start with the big picture, Jeff. If you had to summarize today's economic environment in just a few sentences or a short paragraph, what would that be?
Well, we've got a war in the Middle East causing oil prices to go up, although they have softened quite a bit in the last few weeks because of hopefulness that the war will be over soon, because Trump keeps saying it will be, but of course he doesn't know. It depends when the Iranians and Israel want to stop throwing bombs at each other and each other's allies. You know, I think there's still a lot to be said there. We've got inflation going up largely because of the oil prices, but not just that, is they inject money into the economy every time. In fact, just give you a case in point, last Tuesday, I was looking at the market and I was wondering why all the pre-market was up, and then I realized that it was a day that the government was putting hundreds of billions of dollars of cash back in the economy from a bond buyback, because nobody wanted to buy bonds last week when the sell-off occurred in the market, and they all wanted to go to bonds, and there weren't really many buyers, and so the prices plummeted. But the government offered to buy the bonds, so they put cash into the system. So that's a good reason for the inflation, is just the government manipulation. And I thought that they stopped printing money, but they haven't. They keep doing it every time they want the market to look good. And the market isn't looking that good. If we look at the monthly trends just lately, I mean, they've trended down. If we look at all the indexes, we look at the NASDAQ for the month, it's down. For the week, it's down. The last few days, it's down. In general, this week is not a good week. We've got the S&P also turned down for the month. The trend is reversed. But the market is showing that. It's also because of these IPOs where Elon Musk and his cronies want to basically cash in on the market. And basically that's on the retail investor. The retail investor pays them all their money by liquidating stocks, some of which will come out at a loss. Thankfully, there's been a good run up lately, especially in tech stocks. If you're a tech stock junkie and you want to get SpaceX and Anthropic and all those others and willing to overpay for them, then you'll sell whatever you have at a profit, and hopefully you buy low and sell high, but you won't. If you're a retail investor, you're going to be holding the bag. The market has caused some inflation just by creating more liquidity, and now that liquidity is going to be siphoned off the market by these three big entrepreneurs that have multi-billion/trillion-dollar companies that are going to go public, and money's going to be flooding into them. Institutions and big ETFs and the friends of Elon Musk and those guys are all going to have their pre-IPO stock anyway, so they'll just use the rest of the public to prop it up. What does that mean to a regular investor? It means be careful. It means the market's rigged against you. Don't think that you can just jump in, ride it out, because there's some big forces in the market right now that are very negative. And I don't know if that was really more the focus of your question, was mostly economic news. Well, it's not just economic news, but the market seems to be touted as if it is the economy. And in many ways it is, because if you're making money in the stock market, you can, if you're a day trader making boatloads of money because the market's going up and you seem to can't lose, you buy Ferraris and Bugattis and all that kind of stuff with your money because you think you're rich, then yeah, the economy looks great to you. But it doesn't look good for the guy that is barely making ends meet, feeding a family, and sees gas prices going up, car prices going up, interest rates going up, you can't buy a new house, rents going up, and everything else going up. The average Joe is getting hit pretty hard. And in retirement, most people kind of live like average Joes. You're not out doing your entrepreneurial activities. You're not probably day trading. You're being more of a protection mode. So you're kind of at the whim of these crazy swings in the market, or these crazy forces in the market that you can't control, which is why we go back to, hey, control what you can control. And if you can't control it, don't put money that you might need for cash to live on in that account. If you're betting everything on the market, or betting everything on gold and silver, or betting because it went up and it might still go up and it might not go up. It could go back to $2,000 in the next couple of years, and you could lose half your money if you just bought it. The stock market too, you could lose half your money. We've seen crashes that were that big and bigger. If you look at the NASDAQ stocks, 83% back in the 2000 crash. And I would say the AI bubble is every bit as overinflated if you look at the pricing of the stock market in general than the dot-com bubble. The difference is the dot-com bubble had a lot of companies that didn't have any revenues. They just had a .com after their name. And the AI bubble is based on true economy that could actually happen. The problem is you've got companies like, just name one, like AMD is selling fast chips and its stock. Micron's probably less competitive, but these chip companies are now getting hit by brand new companies nobody's even heard of. They'll probably be like the next NVIDIA's making super high-speed chips. And they're going to take a lot of the market share that's already been priced in to these big companies. These big companies have gone through the moon. Maybe Intel will continue to go up, went from $20 to $120. I mean, it's just a few months. It's crazy that a stock could do that based on future potential sales when we don't even know where those sales are going to come from in reality, because we don't even know what companies are going to be players in a couple of years when a lot of this stuff happens. But right now, we're just building the infrastructure. There's still probably some upside in the market. There's still probably a lot of economy to be driven, but I think it's been overinflated, overstated. I think we're finding that out now, just looking at the volatility in the market and the uncertainty, and the fact that institutions are no longer players in the market like they used to be. Warren Buffett's got over $400 billion in cash. That's more than a third of his Berkshire Hathaway. Berkshire Hathaway hasn't really done anything from a standpoint of performance. He's just sitting on the sidelines waiting to buy things cheap and at a price that he feels like he can afford. So if we look at the big investors, the Ray Dalios, the biggest hedge fund manager on the planet. We look at even insiders in the stock. We look at stock like Meta and Apple and even Amazon, Microsoft. They've all been very weak this last year. NVIDIA hasn't even been anywhere close to what it's been before. So even these big companies are a little top heavy. And while there's a lot of up and comers that are getting a lot of hype due to AI, I think if we see the market get back to reality, I think the truth about the economy and the truth about all this news that we're hearing about inflation, that's a bad thing. Jobs numbers are really not as robust as they say. They're just using these estimated numbers rather than payroll and withholding numbers, which they should use. They've also gone ahead and changed the rules from what I understand, and I have to get more in-depth reading on this, but we'll just say rumor has it, but I've read some things that I think are credible, need verification, but the Fed is actually, or the government is actually recategorizing what inflation is determined by. In other words, what used to be or would be a 3.8% inflation rate is now going to be a 2.4% inflation rate. And if that's the case, I think they need to go back and readjust the inflation rates, comparatively speaking, in the past to just give us an idea of what that really means. But I think the biggest reason that they're doing that is so that they don't have to continue to add so much cost of living adjustment to things like government pensions and Social Security. If they can do that, they're going to save trillions and trillions of dollars over the next few years and hopefully kick that can down the road before they have to start changing the way that they pay out or distribute Social Security funds and trying to preserve them. The thing is it doesn't give us an accurate picture of what the market's really doing and what the economy is really doing. People can feel that they're spending more on everything and that they can't make ends meet. Healthcare costs are going through the roof. What, are we not going to count those anymore because we just assume employers are going to pay them? Well, if employers aren't growing their revenues and bottom lines by 15 or 20% every year, they're not going to be able to afford benefits for their people. People can't afford to pay them out of pocket anymore. They don't have the subsidies that they used to have because of Obamacare. They took those away, largely because of fraud and abuse. But bottom line is a lot of middle-class people need those. Families need them. My kids' families needed those to make ends meet. It's not a great thing. I don't like paying for everybody else's benefits, but I also don't like seeing the middle class and our kids and the future generations struggling as bad as they are because the economy has been basically shifted into the upper class, those people that can invest and milk the market for its benefits, creating inflation, the government printing money, creating inflation, starting wars, creating inflation due to oil prices and everything else that goes up because of it. And we're basically, holding the bag. Getting back to what does it mean for retirees, since this is the premier retirement show, what does it mean to, our base clientele, the typical person planning for retirement is always build a buffer in your retirement plan. I mean, just because it says that maybe a good rate maybe you can spend $150,000 a year and you probably won't go broke. Maybe you learn to live on 120. So there's that little extra buffer. So when hiccups come in the market or when you have that unexpected expense, there's some savings that goes along with that to cover those rainy days and the ups and downs of the things that don't work out in the market. If the market's down and you haven't made any money, even if it is a principal protected account where you haven't made any money, but you haven't lost any money, you're still using income. You still may be drawing those assets down. Wouldn't it be nice to have a little bit extra? Well, that's why we need to build buffers and build a reasonable growth rate into an income plan. Stick to the income plan, guarantee income to the extent that you can. I've seen people come in with plans and say, well, my broker says the stock market averages 10%, so as long as I spend 8, I should be good. Well, that's not true. If the market goes flat or goes down, you're locking in losses and you're going to run out of money. Wall Street really says 4% is the rule of thumb, and Ernst & Young and other CPA firms have done studies saying, not quite so sure. Even Schwab did a study, said it was in the 3-something range. A guy named Wade Pfau, who has a doctorate in retirement income studies, believe it or not, it's actually a major now in some institutions, says that the actual rate probably about 2.5% or even lower if you want to make sure that you're safe from market fluctuations, market downturns, and potential crashes that could happen. And that have happened in 2000 and 2008 during that 2010 decade. That was called the lost decade for a reason. There's 2 big crashes. Our market is overvalued the same as it was in 2000. It wouldn't surprise me that it wouldn't happen again. In fact, statistics are all pointing at the fact that it will happen again over the next 10 years, that we should have a flat market for 10 years. Maybe a crash that takes a long time to recover, maybe 2 or 3 crashes that recover quicker. But the bottom line is we're due for a flat decade again. And what does that mean to your retirement plan? Well, I hope you have guaranteed income. I hope you have things that you can count on. I hope you have some security. And I don't think you should just bet on gold going to $10,000. And I don't think you should bet on the Dow going to 100, in the next 10 years. I mean, it might be below 50. It might be below 40. It might even be half what it is right now in the next 10 years. I don't know. Fact is, control the things you can control and don't expect to live on those things that you can't control, because that's just the hold and hope retirement. And that usually catches by surprise. If you've got 3 or 4 decades of retirement ahead of you, good luck with that, because in 3 or 4 decades, the market's not going to keep doing what it's been doing the last 10 years. It can't sustain that. It won't sustain that. History says it will not. It never has. And in a 40-year period, you're going to go through some severe market corrections. And a lot of those are the consequences of bad government decisions, bad government policies. And if you look at what the government's doing, it's bad government policies. It's kicking the can down the road. It's smoke and mirror games. It's printing money instead of letting the economy work itself out. And while the rich people that donate to these people's campaigns and are hobnobbing with the rich and famous are loving it, the rest of us are trying to get by in this crazy market and doing the best we can. So thankfully, there are tools and techniques that can reduce taxes so you can keep more money, that can create income streams so you can be sure your bills are paid. There's some inflation protection type investments, some income plans that actually go up with inflation. I don't know that TIPS, Treasury, and inflation protected securities are really the answer, but there's different ways to plan for inflation. And it might not be that you take a flat income. It might be that you have growth funds or growth assets that can grow for those inflationary periods of time in the future. They don't necessarily have to be guaranteed income growing, because if they change the cost of living adjustment, what they're doing to the inflation rate, and that correlates with the cost of living adjustment to government pensions and Social Security, you're already going to see underperformance from the standpoint of keeping up with inflation. So how do you build around that? Well, we have a spreadsheet that helps do that. So again, we're going into times like I haven't seen in 40 years. Actually, I have seen them in the last 40 years. We saw them in the dot-com bubble. We saw them prior to the 08 bubble, but it's a little bit different. And I think it's the separation of the classes is a lot more drastic now than it used to be. It used to be kind of everybody was in the same market boat, and only a few of the elites really controlled the market. Wall Street was definitely in control, but people that rule the world, so to speak, I think are in a little bit more control, and they're taking advantage of their powerful influences regarding monetary policies around the world, not just in the U.S. So we have to be careful about that. We have to realize what we've got to work with, do the best we can with what we have to work with, because if you're not already super rich, if you're already retired, there's very low odds that you're going to get super rich. So we have to deal with the hand that we're dealt. And thankfully, there are plenty of tools to make the best of it and to do well in spite of what we might see as kind of an unfair, uneven playing field. And it is. I mean, it's always been uneven. I mean, no surprise there. Have I ever said it was even? I mean, Wall Street, they're so benevolent. They want to give us all the money they make. I mean, that's never been the case before we were all born even. So let's not fool ourselves and think that this is a game that we can always win. We just have to be on the train at the right time. We have to get off at the right time. And thankfully, there's enough tell signs that will tell us when those times are. And I think right now we're going into a very volatile period where you might want to take extra caution. We have reduced our exposure to the market in a big way just in the last week or two. So we still need to see how this market's going to shake out, especially after these new huge IPOs. I think there's going to be some liquidity issues shifting from investments in 401ks. You might see your investments in 401ks get hit hard. We've got the NASDAQ adding these new IPOs, SpaceX, Anthropic, OpenAI. It looks like they're going to be added to the NASDAQ right away, which means NASDAQ has to include them in and buy that stock in order to put them in the index, which means they have to sell some other stock and kind of rebalance, which, may in an overall way affect your other investments. So we have a time ahead of us where we need to be ultra cautious. We've got some things that are happening that have never happened before. Not that I'm going to say it's different this time. It's different this time because it's bigger and it can chop your hand off or your head off a lot easier than it could in the last few times when IPOs are typically smaller and not such a big deal. Again, I've kind of rambled on and bounced around different subjects, but from the standpoint of all the economic news, I think I've touched on a lot of the big ones. And the fact is, if you're worried about all those things, it's probably because you don't have a plan that has enough security built into it, and you probably need one.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Our program, of course, is called Premier Retirement. If you're listening right now today, you're wondering whether your retirement plan is prepared for higher inflation, higher interest rates, market volatility, or whatever comes next. Right now is the time to find out. Jeff Vogan and the team here at Premier Retirement are offering a complimentary retirement roadmap for qualified listeners. Now, this is not a sales brochure. This is not a sales pitch. It's a comprehensive review designed to help uncover potential weaknesses in your retirement strategy before they become costly mistakes. You're going to learn how much risk that you're taking, whether your income plan is sustainable, how taxes can impact your retirement, and whether you're positioned to weather future market uncertainty. So call right now and request your complimentary retirement roadmap. Our number, 520-780-9059, 520-780-9059. You can call right now if you want. Leave your name and number. Shelley will pick that up, and she'll give you a call during the week, and she'll schedule that appointment for you. Again, no cost, no obligation, entirely complimentary. That number again, 520-780-9059. And, of course, you can always find out more about us online at premret.com. Jeff, let's get back to our conversation here about what retirees and pre-retirees should know here in the next 45 to 60 days. And I'm talking about until around August 1st. If you had to advise somebody what they should keep their eyes on during this short time period, what would that be?
Well, I think if they, are out for vacations, they ought to be focusing on enjoying their vacation if they've made a good plan. Now, if they haven't made a good plan, they ought to get one and make sure that they don't lose money, especially in light of what I mentioned in the last segment about the IPOs and a lot of the market shifts and the money moving around that they're doing and the games at Wall Street and the government's playing right now. I think we're in a very precarious situation with the market. I've been saying it's overvalued for a long time, but it looks like the market's finally realizing it is, and we're seeing some really quick and jumpy buys and sell days. Just remember last Tuesday, there was a big injection of capital and the market went up solid for 30 minutes and then it went down the rest of the day. So the little pops in the market are very short-lived. There used to be a saying that in May go away and come back in November and invest. If you look at the months November to May, that's typically where most of the year's gains have been made historically. Now, the last few years, that hasn't been the truth. It's been pretty much any time the market gets hyped, somebody on Instagram says, buy a stock, people run out and buy it. So it's not quite the same. However, there is a little bit less volume during the summertime. Bigger swings can happen due to that less volume, due to the fact that a lot of the institutions or a lot of their money managers are kind of taking their vacations and taking a little more of a conservative step back so that maybe the market is a little bit more vulnerable. So I think summertime's always a more vulnerable time to look at the market. My history of 40 years of watching the market, I tend to get a lot more cautious during the summer than I do during October to May. But nevertheless, you still have to watch the market. We watch it every day and we make sure that we're not caught blindsided. But if you have a lot of profits in the market, I would say take the profits while the market's still relatively high. I know it's down 5 to 10% probably from when it peaked out just in the recent past, but you're probably still able to take a lot of profits off the table from the last couple of years. We just did that with the majority of our growth funds, and we're just going to be very cautious, very nimble in spite of the money that's going to be moving around. I don't want to be in the wrong stocks at the wrong time. I'd rather wait till things settle in and settle down, and there's a little bit more of a relatively predictable momentum shift, and we know where it's going. If it's going up, we'll get back in. If it's going down, we're going to sit on the sidelines or maybe even do some inverse investing where we can make money if the market goes down. We've been making money, for example, on the Bitcoin drop lately. Yeah, you can actually make money on inverses if you're actually managing those accounts for those times. Now, we're not necessarily pessimists all the time. We don't always want to go short the market necessarily. It's kind of scary to do that because just government says print money and all of a sudden it goes up again. But we also want the trend to be intact and be more solid and, like I said, predictable before we get in. And so I would say over the next 2 months, I think we're going to be probably more vigilant than usual in the summertime, just in light of what's happening with the overvaluation of the market, the war, that's the inflation, new Fed chairman, IPOs galore going in and moving money around, people taking profits, and retail investors probably going to lose their shorts. I mean, that's what I see happening based on the fact that companies like Fidelity have lowered the minimums to $2,000 for an account that you can buy IPO, which means you're going to basically get Elon Musk out of his stock at a huge profit and all of his friends just because you're so hyped up about SpaceX. And the only way you can buy it is after it opens in the market. If you already did that, or if you're going to do that, beware that the retail investor is always the one holding the bag. And it's unfortunate that Wall Street, Elon Musk, and all those rich, narcissistic billionaires and trillionaires don't really care about the public. They don't care that what they're doing is at the expense of the average Joe that probably percentage-wise pays more taxes and works harder in many cases. I don't know necessarily works harder, but raising families and trying to make ends meet. And yet they're the ones that when they finally see a chance, they jump on it because it's overly hyped. And then they end up losing the money and paying the fat cats to get fatter when their lifestyle isn't going to be any better than it was before. They're still billionaires and they're still multi-billionaires, and it's not going to make their life better or worse. But when we get caught holding the bag, we're going to be in a position where our lives could be worse if we're kind of a middle-class normal Joe. It doesn't mean somebody that only has $100,000 in savings and makes $35,000 a year. I'm talking normal Joes could have $5 million in retirement assets trying to live on a couple $100,000 or more per year. And that's still a normal Joe in these days. Those guys are still the ones that are Wall Street doesn't seem to have any remorse taking money from those people, from our clients. So we have to be careful. And that's why you hire somebody to drive your boat into retirement. We're on the retirement ship, just out traveling into the sunset. We're on the waters of retirement and we're having a good old time. And, if you've never driven a boat before, you don't know where the obstacles are. You probably ought to have somebody driving the boat that knows what they're doing. And we've been driving that boat for a long time. So we're going to be trying to avoid those obstacles and keep that boat safe and keep us afloat and keep your retirement afloat. There's others out there that don't really care about our boats, but I do. And that's why we're going to keep it afloat. And we're going to take what might be unconventional actions to do it. We'll use unconventional products. We like LERPs and annuities. Wall Street hates them. Why? Because it's counterproductive to making them richer and richer. I want to keep our clients as rich as they got, at least preserve those assets, preserve their life's work with principal protected accounts. We like using those. They're somewhat unconventional. If you listen to the people on TV talking about being fiduciaries, but wanting to keep all your money at risk all the time. Somehow that's good for you. Somehow that's the right thing to do for you. I don't think so. Wall Street, keep it in stocks and bonds. Everything's in securities. Well, the word security means something with risk. It's not secure. There's nothing secure about them. There's a lot of misinformation, I guess, in my opinion, bad guidance in the marketplace right now. Get an advisor you trust that is a true fiduciary, that uses all the tools, that understands your tax situation, your spending habits, can give you some guidance as to what realistic spending habits might be, and you might need to dial it back. I've got a couple appointments this week where I know I'm going to tell people to dial it back a bit. Some that I say, hey, come on, enjoy life. You can spend more. You've got so much safe and guaranteed income. You don't have to worry about the rest of this. That's the good conversation I like to have with people that have saved well and planned well. If you haven't planned, get a plan. I would say that's probably number one on the list. If you have a plan and you have some money at risk, be careful and cautious about the money that you have at risk. If the plan's with us, we're already doing that for you. But if plans with somebody else, typically they're just kind of buy and wait and see what happens and set it and forget it type of investors, yet they still charge a fee for that. I mean, you could set it and forget it and not pay a fee and get the same results. So I'm not sure why people do that. My opinion is if you want to watch your money, watch it, but it is a job. If you want to hire it out or you want to delegate that, then find somebody that looks out for your best interest and can use all the tools in the bag to make sure that your life's work is protected, especially in times like these next few months, as you mentioned. A lot of new stuff happening, a lot of trends maybe reversing, a lot of new news that might affect the way your money's going to work for the next couple of decades or more.
Good conversation, Jeff. I want to remind our listeners that I think headlines will always change. Today's concern might be inflation. Tomorrow it may be geopolitics. Next month it may be something else entirely. But what doesn't change is the importance of having a retirement strategy that is built around income taxes and investments and healthcare costs and legacy planning. I think those fundamentals matter far more than trying to predict tomorrow's headlines. If you'd like to sit down and talk with Jeff here at Premier Retirement, again, no cost, no obligation to do that. Request your Premier Retirement Roadmap by calling 520-780-9059. You can do it right now. Leave your name, number. Shelley will call you back during the week and set up that appointment for you. Again, it is entirely complimentary. 520-780-9059. We're also online at primrent.com. Jeff, time for a break. We'll get a look at news headlines, weather, and sports. When we come back here on Premier Retirement, we're going to be answering listener questions. And then later on in the program, we're going to be talking about gold. Should it be in your portfolio? All that and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan. And you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thanks so much for joining us here for Premier Retirement. Of course, we're here for you on the radio 4 times a week. We're on Saturdays at 7 a.m., 9 a.m., and 1 p.m. Also, Sundays at 11 a.m. And if those times are not convenient for you, of course, you can always join us for a podcast. We're on the air 24 hours a day, 7 days a week, 365 days a year. We're on your schedule. Simply go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You're going to find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Our phone number, 520-780-9059. If you'd like to request your Premier Retirement Roadmap, absolutely no cost, no obligation. It's a sit down with Jeff to ask your individual questions. No cost, as I said, 520-780-9059. You can also find out more about us and request it online at premret.com. That's premret.com. Okay, Jeff, time for listener questions here. John is listening to us in Pima Canyon, and John says, hey, Jeff, I'm 60. My wife is 62. I'm hoping to retire at the end of this year, and we've been doing a retirement test drive by living on the income that we expect to have once I stop working. We have about $500,000 remaining on our home mortgage at a very low fixed rate of just 2.49%. The challenge is that our retirement budget feels a little tight with the mortgage payment, but it would be much more comfortable if the mortgage were paid off. Most of our savings are in tax-deferred retirement accounts. Is there a strategy that would allow us to use some of those funds to pay off the mortgage without creating a huge tax bill all at once? Or are there other options that we should consider before making that decision? I really enjoy the show, and the other Jeff, you guys do a great job.
Well, I'd like to know one more thing, and that is, what do you have in savings? What do you have to work with? You know, is $500,000 going to drain the entire savings, or do you have $3 million sitting around that you wouldn't miss it if it's just a matter of comfort? The thing with about a 2.49% mortgage is, I don't know a way to make less than that in a short-term bond account that is every bit as safe as cash or money market. Even net of fees, you can make more than that. So if you put that $500,000 in another account and made interest on it of more than 2.49, just because you're paying it, now you are paying the mortgage down through cash flow, but if you took the interest off of that account, let's just say you were making 4% on that, there's $20,000 a year, that's what, $1,800 a month. Maybe that would help your cash flow feel a little bit better and you wouldn't deplete your cash. If it's in a retirement account, no way. I would never pay even 10% tax on a retirement fund just to pay off a 2.49% mortgage ever. I just would never do that. Now, if you just really hate the mortgage and you have limited savings, that would be another reason not to pay the mortgage, especially not to pull out of retirement accounts and get hit with the taxes. If you've got a reasonable income to live on, you're trying to figure out how to live on that. Again, I don't know if you're using your investments to live on and trying to live on just interest that you get off of it, or are you depleting them? You have some tax deferred accounts, which means IRAs, 401ks, I'm guessing. What are they in? Are they in risky stocks that you could lose a bunch of? I guess you could lose a bunch of money in stocks if you insist on having all that money at risk. Maybe it would be better to take some of that out of a super risky account that could lose 20 or 30%. That's more than the taxes, to be honest. So maybe that wouldn't be a bad idea. But again, if you have a plan structured like we structure them, I just don't see a scenario where we would say that that would be good in our plan. Given your scenario, I don't know what plan you have, what you're living on, what your source of income are, or even how much you have. So it's a really hard question to answer. Other than that fact, in general, I would never pay off a 2.49% mortgage, even if I had the money. In fact, I have mortgages under 3 and I'm happy to have them, and I don't pay them off any faster than I need to because I'm making more money on all my other money. I mean, my net worth's growing while I'm paying that mortgage off. If I paid that mortgage off, the properties that I own would not appreciate anywhere near what I'm making, even on a guaranteed rate on some of my investments. So I don't see that I let math prove the right answer. I don't necessarily just make opinions. The math will support everything I'm saying here. We have spreadsheets that'll tell us if we're on the right track or not. You might want to also consider looking forward 5 or 10 years because you're trying to live on a budget now to see if you can do it. You might want to also look at what would it look like if you didn't live on that tight of a budget right now and did a whole bunch of Roth conversions so that you could live on a lot more tax-free in the future. You're at an age where you might want to even include LIRPs, life insurance retirement plans that give you tax-free income where you don't deplete the account. You actually just borrow against it while it continues to grow. A lot more efficient than a Roth, in my opinion, especially a volatile Roth. You know, there's indexed products that will guarantee income that you might like, but it might mean you set them up now so that when you're 65 and 67, if you are retiring in about 5 years, that you'll already know exactly what that income's going to be. And if you had a plan, that would maybe give you a better idea of what you need to start spending on, because you might be using the 4% rule, which is horrible, assuming a certain rate of return, which you may or may not get. And you might be learning to live on a retirement plan that is either less than reality of what you could have lived on if you had a plan with guarantees, or you might be living on more if the market corrects, or if something happens and you don't end up having as much money to retire on than you thought you would at that particular given time. So again, I don't know what rules you're using, rules of thumb you're using, what assumption you're using, what you expect to make on your money, how guaranteed it is, how many income streams that you have that are guaranteed or not. So yeah, we'd have to probably sit down for half an hour or so before I'd get the answers that I need even to give you a smart decision. But here's one other option for even wealthy clients. In fact, I have more wealthy clients that use this than the people that seem to think it was made for, and that is a reverse mortgage. If your house is worth $1 million and you owe $500,000 on it, and let's say you could borrow the $500,000, now it's going to be at a higher interest rate, but if you don't like the payment, you could actually borrow it on a reverse mortgage, have it paid off, not have a payment, you'd just be paying the interest and taxes. You could actually get out of the mortgage that way. That $500,000 would grow, and maybe in 20 or 30 years, you might owe $1.5 million, but maybe your house is worth $2 million or $2.5 million. At that time, there's still $500,000, maybe $1 million in equity in that home that you can still pass on to your heirs, but then you get to save more of your money. People that invest or loan money or use private equity that have dividends higher than 6 or 7% or are accustomed to making more than 7% or so are not afraid of reverse mortgages. In fact, it's basically the same arbitrage I'm talking about by keeping a 2.5 or a 3% mortgage on your house and making 5% on it in something else that's just as safe as a money market. You've got a lot of ways to skin that cat. You probably need to open up your mind a little bit more than just assuming there's a 401k and an IRA and a tax bill and securities and Wall Street tools to use. There's a ton of other stuff. And if you're a good financial advisor and a good retirement-focused financial advisor and a fiduciary, in order to look out for your clients' needs, you need to know what all the tools are. And you also need to know what all the current information is. So we'll stop there, and maybe you'll come in for an appointment and we can talk a little bit more detail.
John, good question. And as Jeff said, if you invest about a half hour of your time, probably you're going to get the answer that you're looking for. And again, you can further the conversation with Jeff by calling 520-780-9059. It's 520-780-9059. Next question, Jeff, is Dave and Sam Hughes, and he says, hey, Jeff, I often hear that retirees should spend taxable accounts first, then IRAs and 401ks, and leave Roth accounts for last. But what if leaving money to the next generation is a major goal? I'm 62, my pension and Social Security cover my living expenses, and I currently have about $1 million in IRAs, $700,000 in a brokerage account, and $150,000 in a Roth. Since IRA withdrawals are fully taxable and subject to future RMDs, would it make more sense to spend down the IRA first and preserve more of the taxable account for my heirs? How do you determine the most tax-efficient withdrawal strategy when legacy planning is part of the equation?
Well, if you care about your legacy, you're probably going to want to give them as much tax-free money as possible instead of leave them a big tax burden. So that's one more underscores the idea of spending your Roth last. I think spending the taxable money first is good. The thing with you have $700,000 in a brokerage account, that's the part that really is the kicker for your tax planning. You can't plan taxes around $700,000 in a brokerage account unless it's in CDs or something that's got a fixed interest, then what your interest is. But if it's in mutual funds or traded or managed like we do, you might have a lot of surprises in that brokerage account. I would prefer to have your trading and risk all in your IRAs. Spend that as you need to. Put some in safe accounts every year so that you can take some withdrawals and spend that, pay taxes now, and not leave your kids a tax burden. You might also want to consider moving a lot of that IRA money. Again, I don't know, it says your pension and Social Security cover your living expenses. If you have $1 million in IRAs, you're going to just get hit with taxable income that you don't need, apparently. The $700,000 is going to cause you a surprise tax bill every year. You're probably going to go into an IRMA level. The amount you pay for your Medicare premium is going to go up. You got a lot of issues there. And I think you might want to just bite the bullet and say, you know what, in the next 4 or 5 years, and I don't know if you've got a few more years that you want to dabble and work a little bit, or if you're still working or not, it looks like you're probably retired. But if you want to just get punched in the gut a few years, but never get taxed again, you might want to consider a really serious Roth conversion and even consider a LIRP. LIRP is life insurance with a death benefit. It also covers your long-term care benefits, covers loans, tax-free money anytime you need it. You don't go into a new tax bracket when you get it. It's not used for any means testing like a Roth likely will be. So when you take money out of a Roth, you actually remove the money from a Roth. When you take money from a LIRP, life insurance retirement plan, which you could use some of that $700,000 in the brokerage account for and still have some liquidity, but you could also create basically a tax-free bank with $500,000 or more, maybe $1 million or more that you could spend at your will, and whatever's left in that account will go to your heirs tax-free along with the Roth tax-free. So if you really care about your heirs and you want to leave them a tax-efficient plan, then maybe you just need to be willing to bite the bullet on the taxes, get them done while you only have $1 million in your IRA instead of wait till there's $3 million in the IRA, take the minimum amount you can out so you pay the least amount of taxes and leave your heirs a huge account with a huge tax problem that they really can't get out of. And not only that, but as that $1 million IRA gets bigger and bigger, you're going to go into a higher and higher tax bracket, going to pay more and more on your Medicare premiums. And it's just going to basically leave a lot less, in my opinion, for the kids. You say, how do you figure it out? First of all, I've been doing this for 40 years. I can do it in my head to tell you within a few dollars of what the efficient plan would be as far as conversions for Roths and what to put in an IRA, because I've been designing these plans forever. But there is some backup. My son, the accountant, CPA, Taylor, joined me a little over a year ago and said, I trust these numbers, but I'm going to get some software and build some algorithms that kind of prove it out. And so he's kind of tweaked the spreadsheet that I've used for 40 years and actually came up with verification. There's also tools out there like Roth Maximizers. It'll tell you exactly what the maximum efficient Roth conversion strategy is. And if I look at a plan, I come up with a 5-year Roth conversion plan, that software that he uses to verify, it'll come up with like 4.8 years or something like that. So it comes out really close. We've been doing it for a long time. We know that sometimes it's worth just paying for the divorce and not ever having to be married to the IRS anymore on some of those accounts. And, you can wait till you have a ton of money and then give it all away at a higher rate later, or you can just get rid of the problem sooner for a much lower cost. I'm not saying it was bad to defer taxes on that. You probably enjoyed the tax deduction while you were in your high earning years, especially in your latest earning years where they were the highest, and put money away in a 401k and those tax deferred accounts. But now that you're not working, you have Social Security and pension, which may be less than you were making, especially if you're 62 and you're waiting for, I don't know if you're taking your Social Security now, looks like you might be, but if you waited on Social Security and did a bunch of Roth conversions, use some of that money to spend down and then took Social Security later, that'd be fine. Or you just reinvest with Social Security, put that in a LIRP and never pay taxes on it. Anyway, there's all kinds of ways to give yourself a very tax efficient income stream, probably more than you're planning on now, because when we see people that have a plan, typically it generates a lot less income than we can show them based on guaranteed income sources. And if nothing else, what we can grow on a tax-free basis for your heirs.
Dave, we appreciate you listening to us in the Sam Hughes neighborhood. And again, if you want to continue the conversation with Jeff, it's 520-780-9059. 527-80-9059. Okay, Jeff, next question. Connor's in Tanque Verde. Connor says, my wife and I have many goals in retirement, but the major one is leaving enough funds for both our daughters who have special needs. Trying to anticipate our children's needs when we're not around is complicating an already uncertain process. I believe that the disability community is one of the largest minority groups in the country, and parents and family members would greatly benefit from your advice, especially in the caring way that you present things. Thanks for all you do.
Well, you're welcome. I do have experience in this. As you probably know, I had a special needs daughter. She passed away a few years ago, but that was a very big concern of ours. Who takes care of her if the government programs don't exist anymore? I mean, she had a lot of, help, thankfully, and I have no problem paying taxes to support those programs. I'm glad that the tax money gets used to supplement families that need a little bit of help with special needs children. Sounds like you're going to be caring for adult special needs children for quite a long time. And if they don't predecease you, and some special needs, depending on their situation, don't have any limits on life expectancy and may go beyond that. So, the first thing is make sure you have a special needs trust that explains when those funds that you leave can be spent on that person's behalf. If you have other children or a trustee, somebody that you trust, that will take care of those funds for you and make sure that anything spent out of that trust for the care of your children does not disqualify them for any government benefits, then you'll keep your money intact for that purpose without seeing the whole situation and how disabled they are, what programs they qualify for, what they might not qualify for, or how much money you have set aside for them. It's probably a little harder for me to answer that question more directly than I'm doing now. But, a special needs trust will at least direct your successors on how to care for your children and the money that you leave behind. Some people are real hell-bent on making sure there's millions and millions of dollars set aside for their special needs children. And other people say, well, I'm sure the state will have a program or the government will have a program. They would never let these people starve. Well, I don't know if they will or they won't, but knowing that they're taken care of first can be set up in a trust. And, if you have other siblings, family members, or somebody that you can trust to look after their care, nobody's going to look after it as much as you do, unfortunately. And I know that. And that's probably the biggest frustration and probably the biggest motivation to live healthy, eat healthy, work out, and live a long time so that you can be there for them for as long as possible. So best of luck to you. If you want to talk about special needs trusts, I have experience in that. We have people that can set those up for you and build a plan that based on your situation, we can at least look at what different scenarios of your picture would look like. And then you can choose to move forward on one if you want to do that.
Connor, we appreciate you listening to us in Tanque Verde. And once again, I invite you to call Jeff because he does have experience in this area. 520-780-9059 is the number. It's 520-780-9059. And I'm sure that Jeff would love to sit down with you and help you out in your situation. Jeff, want to remind our listeners once again that if you have questions about retirement, how to get there, and you want to have a one-on-one conversation with Jeff Vogan here at Premier Retirement, certainly you can do that. It's called the Retirement Roadmap, and we're offering it absolutely no cost and no obligation for our loyal listeners. 520-780-9059. You can make that call right now if you want. Leave your name, number. Shelley will return that call in the next couple of days. Set you up with an appointment with Jeff. Again, there is no cost and no obligation. 520-780-9059. You can also find out more about us online at premret.com. Jeff, gold has been one of the hottest investment topics lately. We've seen inflation, geopolitical tensions, market volatility, and now some analysts are forecasting gold prices could go even higher. Is this why so many investors are suddenly interested in gold? Is the potential for the appreciation?
Yeah, I guess so. I have clients of all kinds of different philosophies. Some are just so all into gold that they're ruining their retirement plan over it, and some don't care to have any at all. Frankly, I think the gold IRA that you're talking about, gold and silver, precious metals in an IRA, is one of the biggest scam ripoffs I've ever heard of. I think putting some, just for rainy day purposes, putting some gold and silver in your safe is fine. The problem with gold and silver, the actual bullion, is you typically get a spot price higher than the real price. And then you pay a commission, probably 10% on average, going in and going out. So the first 20% that you make on it, on a round trip trade, buying and selling it, is going to be reduced by 20%. I mean, how can you do that? And really, unless gold has 60 or 70% profitable years like it did last year, how are you going to actually make money over the long haul? Now, we can go back to the 80s when gold was $900 a share and it's only $5,000 now. That's really not been a very good investment over the long haul. We can go 20 years ago when it was bottomed out around $200 or $300. And you look at that period of time and it looks like it's a decent investment. It looks like it keeps up with the market, but that's only because it had the roaring 25s last year. If it hadn't, then it would still be a mediocre investment at best. Some people think gold is a great inflation hedge. I haven't seen gold really appreciate with inflation. Last year, we had low inflation and high gold prices. Gold didn't really go up a whole lot in 22 when we had a lot of inflation, or 23. So it doesn't seem to really correlate, in my opinion. What I do know correlates is as the dollar devalues, gold seems to get a little bit stronger, but the dollar's been holding up in value pretty good lately. And so gold's suffered, and gold's come back 20% from its high not too long ago. So if you're investing into gold so that you can sell a little bit each month or sell sometime in order to live on it, or if you have this gold or silver IRA, you get to RMD age and you have to take, let's say, $8,000 out of your $200,000 gold IRA account, but you have to sell not just enough to pay the taxes. You're going to have to sell to get $8,000 out. You're going to probably have to sell $15,000 in order to pay the taxes and the commission, not to mention the holding fees, custodial fees, all the trustee fees, and all the other things that go along with it. I have a hard time believing anybody actually penciled out the math to see why this even looks like a good idea. If you want to have some gold for a rainy day because the computer systems go down and you need something to trade with your friends and you need to buy a loaf of bread for a Krugerrand or something, I mean, well, good, have some in your safe. I just don't see actual holding the gold bullion, other than the fact that it's a hard asset, makes you feel comfortable, is that big a deal. Now, granted, I have not a significant portion. I think it's a decent amount of money, probably more than most of my clients have in gold and silver, sitting in 3 different safes just for rainy day purposes. I didn't buy it because I can't wait till it goes up to 10,000 so I can sell it. I'll just have gold. I don't care what it's worth. I just bought it. It was an asset that I bought because kind of like a house or an RV I use. I bought it because I want to use it, not because I see it as an investment or something that's going to appreciate and I'm going to make money on. Gold, I think, is kind of that way. Now, if you want to make money on gold, and by the way, we made a ton of money on gold and gold miners last year because we bought ETFs, exchange traded funds that were tied to gold. We had the retirement account that we had was up over 80%. I probably shouldn't talk about returns because you can't guarantee them. Please disclaim that. But, we had a great year because we took advantage of ETFs, but we never owned 1 ounce. My clients didn't own 1 ounce of physical gold. Yet we still made on that portion of our portfolio a really, really good return. And we made a good return up to the first couple of months this year. And then we gave some of that return back because the market plummeted and gold and silver went down 20 to 40%, depending on what you owned from its peak. Thankfully, we got out when it was starting the downturn, not ride it all the way down. We'll probably buy again if the trend goes up again, but it hasn't turned yet. So the thing is, you can be a lot more nimble. I wanted to buy gold in December, which we did. We actually increased our positions in December, but I bought physical gold. And it took me a month to get it. I had to pay a 10% commission. And let's say I bought it at $5,000. And by the time I got it, the spot price went to the $5,500 plus a commission. So I'm actually into it for now for almost $6,000 an ounce. And then it starts plummeting. I go, oh crap, I got to get out. It's down to 5,000 again. So I sell. By the time I sell, it's down to 4,500 and I have a commission. Now I get 4,000. I just lost a third of my money in 2 months because I wanted to buy and sell actual gold. You can do that with an ETF. So we ended up making the 20% from December to February, and we ended up losing 15% when we got out. Guess what? We're still up 5, not down 30. So, owning the metal and trying to take advantage of the market ups and downs. Now, that was a very short-term example of trading. So again, I would never buy. And by the way, if you're planning on using some of those assets to live on because it replaced some of your stocks and bonds that you were planning to liquidate to live on over the years in retirement, then you have to plan then on selling from time to time, right? Well, selling isn't instant. You don't even get to lock in your price from the minute you say, hey, I want to sell. You don't really even know what you're going to get. It usually fluctuates a few percent. So just the uncertainty of it bothers me. The extra costs of it bother me. The fact you have to use a custodian. And the only guys that sell those IRAs aren't people that would ever own them. I think they're too smart to own them, but they're smart enough to dupe you into owning them. I'm very opinionated on this, and I know some people listening are going, oh, wait a minute, I have a gold IRA. I think it's great. Well, okay, good. I think they're a waste of money, and I think that they tie your money up in a much worse way than just having gold and silver in your safe where you can just take it down to the coin shop tomorrow and at least get a price for it or get most of your money back for it minus commission, or even go to a trader, a broker that'll at least get you a spot price for it and overnight it to New York for you and cash you out. So that's a lot simpler. I've had people try to get money out of their trust. It takes forever. There's all these hoops and rigmarole. I had a lady that was up like 30% in gold, and because of all the storage fees and the fees that they charge her, she actually lost money earlier last year. And it was like, how does that happen that people just get suckered into this? And the people that sell the gold sell it with like, oh, it's a good gold inflation and silver is great. And it is if you can get in and out of it. And honestly, I don't even know if the ETFs are really supported by actual gold. I know at least the IRAs are. So I guess that's one thing they say they are. I don't know if they are. Don't know how audited they are, or if storage of gold can actually be set aside kind of like a money bank account in a bank where they only have to have so much of the deposit on hand. So I don't even know how all that works. I do not recommend them for my clients. However, I do recommend that when the price of gold and silver are going up, we jump in and take advantage of it by buying the ETFs that are tied to prices of gold and silver, because we can liquidate them and get out in a matter of minutes if we want to. And what do you pay? 1% a year to your advisor to buy and sell it when he sees the opportunity. So again, we can play the gold and metal game a lot differently than the IRA game. The IRA game is a moneymaker for those trust companies that offer it. And I really don't see, I have not yet in 40 years of my life, I've not seen the benefit of how that actually comes out better than the way I just explained how we do it.
Jeff, we've had a great conversation today, but we're almost out of time. 520-780-9059 is our number if our listeners have questions. And of course, if you missed any part of the program, remember, we're also a podcast wherever you get your podcast, or simply you can Google Premier Retirement with Jeff Vogan. You'll find this show and all of our past shows. Jeff, out of time for this week. I want to thank you for your time, but most importantly, I want to thank our great listeners for joining us here in the greater Tucson area. So for Jeff Vogan, I'm Jeff Shade, wishing you a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.